The Census Bureau has asked Congress for a 120 extension. I don't know that you even have to ask, and I think 120 days isn't nearly enough.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
We're on course for a fourth week of losses on the S&P 500 and the Nasdaq 100 as well. On the S&P right now, futures -12. We're down 0.4% on the Nasdaq. We're up just 4 points, barely positive on the equity benchmark right now in the United States. If you switch up the board, in the bond markets, you hear the opening bell. Here's the story for treasuries. There isn't one, and I guess that's the story. Treasury yield's doing nothing. 0.66% is your yield on a 10-year. And foreign exchange is all about Europe. I said Monday morning, the happy talk is over. Euro dollar 116.34, down a third of 1%. And in the commodity market, a break of 40 on WTI, $39 and around about 90 cents. We come in almost 1 full percentage point. That's the cross-asset price action. Let's get you the movers at the market desk. Here's Abigail.
John, let's start out with a bright spot going against the grain of the open here. The travel space doing relatively well, especially the cruise line space. Take a look at Carnival, up nearly 6%, and Royal Caribbean on an upgrade over Barclays to overweight. The analyst saying that there is an inflection point. The risk reward favors buying these stocks, even though it may take a little while to work out. Boeing is also popping nicely higher, up 0.5% on the news that their recent 737 MAX test flights are going well. American Airlines and the airlines flipping back and forth, a piece of the volatility that we have on the day. And the bigger clue to that volatility, John, will of course come with the FANG complex. If we take a look at Amazon, Apple, Nvidia, Tesla, right now we do have some gains for these stocks. This set of movers, if you can believe it, 30% of the Nasdaq 100. If they can close higher, you might see the markets hang in there. But this is where all of the volatility is, these big names. Apple right now heading toward its first up week in the month of September, John.
Abigail, the choppiness has been brutal. Looking forward to catching up with you later in the session. 2 minutes in, about 90 seconds in. Energy getting hammered again, down 1.5%. That is leading the losses this morning. Financials, materials moving down alongside with energy. On the upside, we see a move in IT, barely positive. That sector up about 0.2% on the benchmark. The S&P 500 up around, or rather negative, around about 0.25%. The swings in five flying mega caps forcing investors to question if history is repeating itself as tech bulls begin questioning the rally.
We are at levels we haven't really seen since 2001, 2002.
Substantial option dynamics at play.
Stocks trading at ludicrous valuations.
Things are coming back down to earth.
We're just on the cusp of going over some really terrifying cliff.
It is starting to look toppy.
We're not in a bubble.
I'm a seller of that view.
This is starting to feel maybe a little bit like 2018.
This correction we've endured since the peak in September has lots of echoes to history.
For more, let's bring in Bloomberg's Scarlett Fu. Good morning, Scarlett.
Good morning, John. Yeah, sentiment on the biggest and most influential part of the market, and until recently, the best performing of the part of the market has begun to sour. You have data from B of A EPFR, which show U.S. stock funds bled almost $26 billion in the week through Wednesday, a sharp 180 from the previous week's inflows. And of course, tech funds are leading the way. You can see the price action reflecting this. The Nasdaq 100 is set for its worst September since 2008. Gone are the days of slow melt-ups. That was back in August. The Nasdaq 100 closing with a move of at least 1% in 14 of the 17 trading days this month. You can see here that it's closed up or down by at least 1.5% on 8 occasions, the most since April. Now, you can blame it on an absence of stimulus from either Congress or the Federal Reserve, the resurgence of COVID in Europe, while the U.S. death toll tops 200,000. All of this as a vaccine remains a distant hope, and nervousness before the election. We started September in the wake of two high-profile stock splits. Now, even though a stock split only changes the price per share and not a company's market cap, Apple is in correction mode while Tesla is in a bear market. We know there's a lot of cash on the sidelines. Money market fund assets are up 21% from late February when the S&P 500 made its last high. So how do you deploy it? With volatility here to stay in the short term, Kristen Bitterly of Citi Private Bank says consider options, selling out of the money options to take advantage of the rise in swings and get paid to wait for a better entry point. John?
Scarlet Fu, great work, as always, thank you. On the tech sector, BMO's Brian Bowski saying the sector is substantially better positioned than it was 20 years ago, running the following. After a 62% run-up in tech since its March lows, all it took was a 3-day sell-off to shake the confidence of investors and incite renewed fears of a severe and prolonged price decline comparable to the dot-com bubble. We find these constant comparisons to the early 2000s pretty absurd. I'm pleased to say, with a glass of freezing cold water, call it a bucket, Brian joins us right now. Brian, great to catch up with you, sir. I've never liked the 2000 comparison myself either. I don't know what it's a good benchmark for. Can you just walk me through why you hate it so much right now?
Well, if you go back to 2000, we were looking at tech companies and valuing them on EBITDA and enterprise value. You don't hear about that right now. All you really hear about is high PE ratios, which there was a clip in that prior hit that you said they're absurd. They're not absurd. In fact, if you take a look at PEs on an LTM basis, meaning last 12 months, there's about 1,000 basis points below than what they were in 2000. But more importantly, you have a numerator and a denominator with respect to evaluation, John. And you take a look at how earnings have become excessively stable in the technology sector. In fact, over the last 10 years, they have become the most stable sector earnings in all of the U.S. Now, with respect to the cash flow and balance sheets and things like dividends, 3 times as many companies in the technology sector are paying dividends now versus 20 years ago. And I think, too, the diversification with respect to fundamental operations in the technology sector are vastly different than they were in 2000. We were mostly talking about hardware and some services and technology. Think about the importance of technology with respect to energy or especially healthcare as we try to get a vaccine out. So, again, I believe that the tech bears lack imagination, and they're just bitter because they mostly missed this move. And now, given the fact that markets are volatile again, and people seem to forget that September is the most volatile month of the year, the most negative month of the year, and third quarter is the most negative quarter of the year, that all leads to a very positive fourth quarter historically if you look at prices going back to 1945.
Well, Brian, let's talk about the psychology of this market then, just the nature of confidence and how quickly we extrapolate out the volatility we experience at the moment out several months. What do you think about that at the moment, Brian?
Well, I think the best way to combat volatility is with quality. You hear a lot of people come on your air and talk about high quality, but the best way to compose a quality portfolio is to barbell high quality growth on one side and high quality dividend growth on the other. Remember, there's 3 types of growth. And the thing that you want to remember is when growth is scarce, growth outperforms. We're all worried about employment growth and the economy going and trying to depict the shape of the recovery, just like we were 10 years ago, by the way, when we were incensed with trying to pick out the shape of the recovery. There's secular growth, there is cyclical/value growth, and there's dividend growth. And we think you should own both. We've proven through our work that during periods like this in higher volatility markets, especially in the early days of a bull market, which again, we believe that the second half of the 20-year bull market started in March, during the beginning stages of bulls were much more volatile. And you need those high quality growth factors, which tech gives you, which parts of financials and consumer staples give you, and oh, by the way, which dividend growth gives you, which we believe dividend growth as a standalone asset allocation sleeve should be a very important part of all portfolios for the next 10 years.
Brian, you mentioned the cyclical bucket, so let's go there just briefly. I caught up with David Costin at Goldman Sachs earlier this week, and we had a similar conversation. And I asked the same question I'm going to ask of you. I don't want to get too cute about it, but in your mind, the distinction between cyclicals and value right now, what is that distinction for you, Brian?
Well, it's a stock picking distinction, and it's a great question. I think the biggest trap that people get into is making this value call or this overall cyclical call. It's a stock by stock thing. So Ecolab, for instance, has a great operation, and they're starting to show cyclical growth within some of their operations. The big banks, like Bank of America, JP Morgan, are showing different cyclical growth within their own operation, whether or not it's wealth management or capital markets. It's very difficult to say buy value or buy cyclicals. You have to buy companies, and I think that's the trap that people have gotten into, and that's why this overall value move has not worked.
Solid advice, Brian, as always, and great to get you back on the program. Let's not leave it so long. Let's keep getting you back. Brian Baskey of BMO, it's good to see you, sir. 8 minutes into the session, equities down on the S&P 500 by about 1/3 of 1%. On the NASDAQ, we come in a little more than 1/10 of 1%. For the market desk with your movers, here's Abigail.
John, let's get a little bit more granular with some names that are moving in mixed directions, starting out with DraftKings. This stock is popping higher. This, as Argus has initiated with a new buy, saying that this company is likely to dominate the online gaming space, which may benefit the company as some states loosen up restrictions. Florida, the engineering and construction company, down after they missed. They restated 2019 estimates, write-downs bigger than expected. And Devon Energy down about 2%, and this may have to do with some Bloomberg reporting that candidate Joe Biden may shut down New Mexico, the Permian side of the basin, if he is elected. As for the big name, John, Apple, all over the map. I wish we had an all-market GIP on the day because it's been down 1%, up 1%. Now it's about flat. But this weekly chart, John, shows the story of this week. Volatility is the name of the game. Huge uncertainty. Nobody knows. Up, down, up, down. On the week, though, right now, John, Apple is up 1.2%, headed for its first up week of September. Let's see if that can remain toward the end of the close. It seems recent days tell us anything is possible.
Anything is possible. We have been all over the place throughout this week. The last 24 hours an example of that's for sure. Abigail, thank you. About 10 minutes into the session, equities down about 1/3 of 1% on the S&P 500. We turn now to live pictures of the U.S. Senate, where the late Supreme Court Justice Ruth Bader Ginsburg will lie in state. Members of the House and Senate joining Ginsburg's family attending the ceremony in her honor. We'll bring that to you live on Bloomberg TV and on the terminal at LiveGo. This is Bloomberg.
see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
13 minutes into the session, your equity market dead flat on the S&P 500, slightly positive on the NASDAQ. I've got to say this week has been choppy for this benchmark in the United States. In Europe, as the US is slightly firmer, Europe breaking down a little bit. The DAX off by 1.4%. In Paris, France, the CAC 40 off by 1.21%. Looking ahead to the election, investors pricing in more uncertainty, but Goldman Sachs saying fears of a delayed result might be overestimated. Strategists writing the following: while we recognize that an especially uncertain election outcome could have a significant negative impact on risk sentiment, we think this outcome is less likely than current market pricing and client conversations seem to imply. For more, let's bring in Bloomberg's Kaylee Lyons. Morning, Kaylee.
Good morning, John. Well, I would point out here that what Goldman is referring to is the likelihood that we'll know who the likely winner is on election night. But I would point out that we did not hear the president committing this week to a peaceful transfer of power, instead casting doubts on mail-in voting. And that means that even if we know who the likely winner is on election day, there still could be a contest. And the market is reflecting that uncertainty. If you just take a look at the SIBO volatility index, or the VIX, and the pricing of futures contracts for October and November, the November contract now actually exceeds the October one. That November contract runs through November 21st versus the October contract, which runs through election day. So that shows that more elevated premium, that investors are expecting this volatility to continue well beyond November 3rd. And that's not just applying to equities, John. It also applies to currencies like a dollar yen, which we're looking at here. That 3-month versus 1-month implied volatility spread now at the highest since at least 2016. That's a significant premium. And as we know, currency volatility really across the board is elevated at the moment. And when you look at